Morning, everyone, and thanks very much for joining me this morning. It's Wednesday, it's the 3rd of August. This is the morning market review with myself, Russell Shaw. And I'm the Senior Market Specialist at FXCM. My email address, rshaw@fxcm.com. Just going to bring up our high-risk investment warning. I'll keep this on screen for a few moments. We'll go for about 15 minutes or so, then we'll switch webinars and we'll go to the crypto minute. Just around the crypto minute, there is a lot of compliance around cryptos, and it's very difficult to kind of juggle that on a regional basis because different regions have different regulations. So just to let you know, we're going to hold the webinar, but then I'm not going to upload it to YouTube because if it goes up to YouTube, it can be accessed by people in regions where there would be a regulatory issue. So just want to give you sort of a heads up about this. So, and it won't go into Telegram either. Okay, so if you don't see it, it's just nothing I can do about that until I get more clarity. So just wanted to put that out there. Here's our market commentaries disclaimer. I'm going to keep this on screen for a few moments. Hey Anna, morning and welcome. Nice to have you on the webinar. Thanks everyone for joining. Yeah, you can record it yourselves. I mean, that I would expect would be okay, assuming you have the software. I mean, certainly I wouldn't be able to stop that or be aware of that, but you won't be able to download it, and because it's just in terms of the regulations, I need a bit more clarity there. So I guess I mean, so where does it get stored? Just to let you know where it does get stored. It gets stored in the GoToWebinar library, which is password protected. It's our account. So I could potentially give download links to that. Again, I don't want to promise. I'll need a check with compliance before I do that. So you can certainly email me and say, please provide me the link, the GoToWebinar link, because that's not public. It's not public, right? But again, I don't want to make false promises here or overpromise. Just send me the email and I'll check with the compliance department to see if it's okay. Yeah, and it includes today. Yeah, it will include today. All right, so here's our references. I've just added this, I hope I've referenced it correctly, Bank of America Investment Strategy, Bloomberg. This is something interesting I wanted to share with you guys that I found on LinkedIn. I'll tell you about it when we get there. And I think what we can do, I'm just going to up this sort of mess of a chart for now. This is related to what I found on LinkedIn. I'll come back to that in a moment. Let's just go through the CNBC note for Europe, and it reads as follows: European markets head for lower open as negative sentiment persists. European stocks are expected to open lower, continuing the regional trend downward this week. In the US, the three major averages fell for a second consecutive day yesterday, although the Dow Jones Industrial Average futures were higher last night. In the hours trading, Speaker Nancy Pelosi's controversial visit to Taiwan weighed on investors, who worried it would strain already tense US-China relations. China has spent weeks warning her not to make the trip. Markets fell further after three Federal Reserve presidents hinted that further rate hikes would be necessary to combat high inflation. That's not a surprise, right? And I think we've been way ahead of that call. Overnight, shares in Asia Pacific were mostly higher Wednesday, with mainland China markets leading gains despite Pelosi's trip to Taiwan, which is being closely watched by Beijing. China's foreign ministry spokesman, and I beg your pardon, I won't pronounce this correctly, but it reads Hua Chunying, tweeted that Pelosi's visit was major political provocation. While a spokesman for a People's Liberation Army Eastern Theater Command said it would conduct a series of joint military operations around the Taiwan island from the evening of August the 2nd. Those operations include long-range combat fire, live shooting in the Taiwan Strait, and conventional missile firepower test launching, the statement said. It's a busy day for Europe, with Commerzbank, SocGen, and BMW, Banco BPM, Siemens, Healthineers, Viola, Wolters Kluwer, among those companies reporting. On the data front, Eurozone producer price and retail sales data for June are set to be released. Okay, I think a lot of those my tongue got tired, so I'm begging your pardon. All right. Let me just show you what I saw on LinkedIn, which I've downloaded. So it's a chart by a chap, or it's a chart that was posted by a guy named Klaus Wober, and the idea here is he is quoting this chart over here. He's quoting this chart over here, which is the source, Bank of America Global Investment Strategy, Bloomberg. And I think it makes for a really interesting discussion at the very least. We've been talking about initial jobless claims for some time now. And what this chart shows here, so we've got the US initial unemployment claims. This is actually a weighted moving average. So it's slightly slowed for, is it WM? I'm guessing is a weighted moving average. It's certainly not a weekly. Yeah, it's a weighted moving average. So I think about that, I guess, as an exponential moving average. Nobody really uses weighted moving averages very much anymore. And you can see that's this dark navy blue line. This is the, it really kind of is an outlier when we're going to lockdown, so probably worth just ignoring that for the time being. And then what we have here is this light blue line, which is effectively a relative strength, right? So it's the government bonds versus stocks. And one interesting part to this relative strength is what they term the total return. So what total return is, just to give you an idea, is that they've included dividends in the, I assume, the S&P 500, and they most likely including interest rate payments in the returns for bonds. And the correlation's astounding, isn't it? So let's just explore. Let's unpack this, and then just make some sense of what we're looking at here. And what I would do is separate these charts. Let's move this to a new pane below, so we can see exactly. So this top chart here. So this would not be total return, but it would be fairly similar. Okay. So what am I doing here? I've taken the US 10-year yield, and I'm inverting it. Why am I inverting it? Because yields move in the opposite direction to price. So I want to get a price direction. So this first term over here is effectively 1 divided by the US 10 years. So there's quite a bit of massaging that's been done. So we've got 1 divided by US 10 year, and then I'm dividing that by the S&P 500. Now, is this meaningful in terms of actual specific returns? I would suggest that with all this massaging that I'm doing, the best that we can talk about here is that we are just getting a directional bias. We're getting a relative strength. And what we're seeing here is that from this period, so from this period here, you can actually see that the price direction of bonds, okay, generally underperforming returns on the share market. However, the real application of this, because we want to marry it with the initial jobless claims, is when we look at the correlation between how the bond market fares compared to the equity market when initial claims start increasing. Initial claims being a proxy for recession, right? So that's what this red line is over here. So what we're going to do is we're just going to overlay it. So we just go move to the existing pane above. Okay, and we're overlaying it. Just to also, I'm using a logarithmic scale on the unemployment claims. I'm not using logarithmic scale on the percentage ratio adjustments. I don't think that makes sense. So you can see now that the correlation pretty strong. So the correlation coefficient here has now gives us a little bit more insight. It's showing us that the initial claims, when they increase, well, guess what? The bond market tends to perform better than the S&P. Now we've got to be very careful with the way we think about this. Remember, we're not looking at absolute returns here. We're looking at relative returns. So both markets can be moving down. It just would be that the bond market is moving down at a slower pace than the equity market. We would have to go into particular periods to identify that. But the point being, of course, that there is a fairly strong positive correlation between recessions and bond performance against equities, which makes sense. Now, there's a conundrum here. Okay, let's just understand the conundrum in that there is a potential time period bias because we are in a stagflationary environment, or we can debate we're in a stagflation environment, which means that this period down here is probably what we want to be looking at, except we've got no data there. And if you take a look at this chart here, it doesn't go back as far. So there's probably some sort of time series bias in, but I've got to, I don't have the data to really give it a proper analysis. What I mean by a time period bias or a stagflation environment, I think that the tension between interest rates and economic activity is not adequately reflected in this period. However, I don't think we should discount it either, because it's a relative performance. The way that the stagflationary environment affects the bond market, it may have sort of a flow-over effect into equities, meaning that the relative relationships are not adjusted too badly. Just to end off with, okay, you can see that after COVID, the correlation has tightened up considerably. We're at 0.78. So there's a very strong correlation now between the initial claims and the bond performance over equities. Again, on a relative basis, not on an absolute basis. Yeah, so how do we find that on LinkedIn? I'm happy to email this chart to you. So the guy, I kind of found it through a comment of a comment of a comment. So a guy named Klaus Wabi, just email me and I'm happy to send all the relevant information to you, and I will post a link of this webinar under the comments so Klaus can see it as well. All right, I think what's the whole point of this? The whole point about this is that initial jobless claims are moving up. That's this red pickup here. All right, but that means that the equity markets are potentially going to underperform, potentially, because we don't know. There's no forecasting. There's just inference, right? And if that's the case, you know, again, it probably gives us some sort of directional bias in terms of our trading analysis. With that all said and done, we're going to end here. I'll see you guys in the crypto minute. Thanks very much, guys.